Hello, my name is Michael Swanson. I run the website wallstreet10.com, and I run a private group for high net worth and institutional investors and traders called Power Investor. There's two things I want to talk with you about today. First of all, I released a special report to this group that highlighted 3 biotech stocks that I believe are bubbles, that are overvalued, and are going to completely collapse in the next 90 days. Secondly, I have 5 stocks I want to talk with you about that are in the NASDAQ 100 that I think are also in a position to go into a decline over the next couple weeks also. If you recall, back on August the 2nd, I released a special public video highlighting 5 troubled stocks. I thought the stock market was likely to decline in August, and these were 5 stocks that I thought would fall even worse than the stock market would fall. Even if the market didn't fall, I thought these stocks were going to drop anyway. And boy, did they wipe themselves out, and in fact put options that you could have purchased to bet against these stocks completely soared in value. And in fact, there are a couple people that watched this video that did just that. Now, before I talk to you about these 5 widely owned stocks in the NASDAQ 100, we need to talk about what's going on in the stock market itself first, because we saw a pretty amazing stock market decline. On August the 20th, the Dow fell 1,000 points that morning, but has since bounced back up. However, since that wild drop in August, there have been big up days in the market and big down days. There's lots of confusion about what's going on. People are nervous about this type of market activity, and they don't really understand what it represents, so therefore they don't know what they should do to deal with it. So let's take a look at what's going on here. I divide a market up into 4 stages. And if you align yourself with the trends of the market, then you can make real decisions. The stages are a stage 1 basing market, a stage 2 bull market, a stage 3 topping market, and a stage 4 bear market. During a bull market, the long-term 150 and 200-day moving averages act as support, and in a bear market, they turn down and act as powerful resistance. You can see, for example, how the moving averages did this in the bear market that lasted from 2007 to 2009. Same thing happened in the bear market before that and all bear markets. Now this summer, the U.S. stock market completed a stage 3 top, when most stocks that trade on the New York Stock Exchange, the S&P 500 and so forth, actually fell below their moving averages, even though the market averages didn't, not yet, because a few remaining stocks continued to go up and help the averages out. But most of the stock market was in a bear market by the end of July. And the NASDAQ topped out on July the 20th, when the final stocks leading the bull market peaked out and had their final run. And then stuff started to deteriorate by the end of that month. And I pointed this out when this happened and warned about what it meant. And that's why I released that video on August the 2nd about 5 stocks that I thought were in big trouble. But then suddenly, on August the 20th, the S&P 500 closed below its 200-day moving average to begin a full-blown stage 4 bear market. 2 days later, the market averages collapsed. That big drop was troubling, but most people did not sell out of their positions when this drop happened. Most people are simply holding on in hope that the market will go back up to its highs. And almost everyone you've seen on TV has been saying that what has happened is just a correction in the stock market, and that the stock market is going to go sideways and trade like it did in 2010 after the famous flash crash of that year, or in 2011. During those corrections, the market quickly retested its lows and built a base to launch a rally off of. However, this time is different. For one thing, this drop that we saw in August was preceded by an epic stage 3 top marked by months and months and months of internal deterioration inside the stock market. Secondly, the stock market averages have now fallen so far below their long-term moving averages this time that those moving averages are now so far away that they are now giant resistance points for the market. And finally, this time the market is not retesting its lows and basing like it did in 2010 and 2011, but instead is putting on a classic bear market rally. Retests happen quickly during the basing corrections, but in bear markets, the rallies don't retest immediately, but the market goes up and fools people. You see, in bear markets, you get giant swings in volatility, wonder rallies, and that's what we're seeing now with the big intraday swings we've been witnessing the past 2 weeks. These rallies don't come with base building. Instead, they're fueled by short covering, and the market goes up fast for a few weeks and then rolls over and falls again into another big bear decline. The current move up that we've seen in the stock market off of the August low is exactly like the rallies we saw in February 2008 and in August of 2008 after substantial stock market declines during that bear market and ahead of the crash that played out in October and November of 2008. It's classic action of a bear market. So once this current bear market rally comes to an end, you can expect to see the market to just go straight back down to the lows again of August and fall even more. We knew the market was in trouble in July because we saw the internal deterioration that had been taking place. So we knew a big drop was going to come. And it did. Now I admit I did not know the Dow was going to fall 1,000 points in one single morning, but I knew a drop was going to happen. And none of the people that were bullish on the market were able to see the drop coming, but I was paying attention to the real trends in the market and internal action when everyone else wasn't or was trying to ignore it. And now I understand how this current move is a classic move that you see in a bear market rally. Now this rally may continue and we may see the market go up right before the next Fed meeting this Thursday, or maybe get a pop after the Fed meeting. But this rally is going to be short-lived, and I think in the week following this week, we're going to start to see the market fall right back down and go into a decline by the end of this month and into October, November. That's going to be just as shocking as the drop that we saw on August the 20th was. So any pop-up this week and around the Fed meeting is basically just going to trap people and fool them, just like the NASDAQ high in July did. You see, this is now a real bear market, and you have to adjust and adapt to that reality if you want to do well in the financial markets for the rest of this year. You see, buying stocks on breakouts and buying bull stock market patterns worked during the bull market, but those patterns stopped working months ago. So what you need to do is bet against stocks if you want to make money when the stock market drops, and reduce positions in stocks that are acting weak and are not performing as well as the stock market as a whole is, because those are the stocks that fall hard when the stock market has its drops. So take a look at these 5 stocks. First of all, take a look at Netflix. Netflix was actually the top gaining stock in the NASDAQ 100 from the start of this year till July. And then all of a sudden, something started to happen. Netflix started to lag the S&P 500. See the relative strength indicator right below the chart. Now, what happens when stocks lag the S&P 500 in a bear market is when the market bounces and has bear market rallies, these stocks don't go up as much as the market does. And then when the market declines, they lead the drop down. These are stocks you do not want to own, and if you want to bet against stocks, these are the stocks to short sell, and these are the stocks that buy put options on. You could short Netflix right now and put a stop above, let's say, 115 and do very well in it, I believe. Another thing that tips us off that Netflix is a troubled stock is the on-bounds volume indicator at the very bottom of this chart. This indicator is formed by creating a tally of up volume days, days where the stock is green, and adding up the volume on that day, and then subtracting the volume when the stock has a down day. So when the on-bounds volume indicator goes down, that's a sign of distribution and selling in the stock, even if the price hasn't begun a big decline yet. You can see the on-bounds volume indicator actually peaked out in June and has been trending lower. That's a sign that Netflix is actually a dangerous stock to own, and it's one of the most widely traded and hyped up stocks now in the stock market, and you need to avoid it, and you may want to actually consider betting against it. Now, Qualcomm is the next stock in the NASDAQ 100 I need to highlight and warn you about. As you can see, relative strength for Qualcomm has been in decline now for over a year. The stock has barely been able to rally this month, and it fell from $64 all the way down to close to $52 in August. It's a stock ready to make another leg lower this month, and I think it's going to actually go into something that we could describe as a collapse in October and November. I mean, 62 to 52 is a big drop. Wait till you see it happen again. And notice on-bounds volume is in a steady decline, showing us big distribution going on with Qualcomm. Now, take a look at Baidu, another stock in the NASDAQ 100, and once again, a stock that's been lagging the market for a year, on-bounds volume, and a big decline, a stock that really has not been able to do anything over the past 2 weeks, and it fell from 210 all the way down to 100 when that big Dow 1000 drop played out in the month of August, or fell from 210 from July to August, basically July the 20th to August the 20th. That's a massive drop. This is a stock you must avoid it, and you may want to bet against it if you want to make money in the next decline, or hedge your positions. It's a good stock to do that with too. Now, Wynn is the next stock I need to tell you about. Wynn is in a nightmare decline. I actually recommended shorting Wynn last September. I wasn't as bearish on the market as I am now, but I did a report saying casino stocks are in trouble, so they're a good sector to use in a portfolio for hedges. But now I think you got to be more than just hedging a portion of your portfolio, but really be on guard for the next big decline. I think it's going to happen in October and November. But notice the relative strength for Wynn has been declining for over a year. On-bounds volume actually made a new low on last Friday, September the 11th. It's a stock that can be shorted with a stop loss order placed above 80. And Wynn fell from 110 in July down to close to 70 in August. That's a big drop, and another big drop like that I think we can expect to see by Thanksgiving. Now, finally, the last stock I wanted to warn you about is Applied Materials. It's been a disaster, and it's in the NASDAQ 100, and it's barely been able to go up over the past 2 weeks, and it fell from $20 around at the end of June to below 15, around 13 by August the 20th. You can see relative strength trending down. You can see on-bonds volume trending down, barely bounced over the past week. This is a stock that you must avoid, and you may want to bet against it. And here's the thing about this stock. This is exactly how most semiconductor stocks look. There's 88 semiconductor stocks. There's about 30 that are in the ETF SMH. Those 30 stocks are doing better than the other stocks that aren't in the ETF that are semiconductor stocks. Why is that? Because there's very little real liquidity in the stock market anymore. That's what happens too in a bear market. When you get the bear market rallies, there's actually few stocks that do well and most stocks actually lag. That's exactly what's going on just about across the board throughout the entire stock market, with only a few sector exceptions, and those exceptions aren't the popular stocks talked about on TV. The technology sector that was so hot over the past few years is no longer hot, and the biotech sector in particular is very troubled, and that's why I highlighted in today's Power Investor Report 3 biotech stocks that I don't think are just going to decline like these stocks these 5 I've highlighted that I think are going to decline. But I think these stocks are in a position where they could actually totally collapse because of fundamental valuation problems and the fact that they have no profits or earnings to speak of at all, and are just bid up on hype, and they're just a lot of hot air. On August the 20th, we start a real bear market for the stock market. That means it's time to readjust to that reality